Welcome again and welcome back to the fourth session of the not-for-profit seminar for the day one. This is Matthew Saha. If you've been with the other sessions, you already know me and you've heard me introduce myself 3 times already, but I'm the leader of the not-for-profit industry practice for the firm. Just a few housekeeping reminders. Again, remember that you'll have to answer at least 3 of the polling questions. Those are the way of tracking attendance for you. So there will not be a separate attendance tracker. There'll be 4 polling questions. You need to answer at least 3 of those to get CPE credit. So make sure that you hit those. They'll be up for 60 seconds. Also, there's going to be a short survey, as there has been after the first 3 sessions. Please fill that out. CPE certificates will come to you within 10 days of the culmination of this event. If you have any issues, there's a website on the screen or a email address that you can reach out to if you do not receive that after 10 days. Again, this is going to be recorded, so that will be your access to the content after the webinar. We won't send out any PowerPoint decks or any other handouts to you. The recording of the webinar will be the only resource to go back to at the end of this. If you have any questions, please use the Q&A pod. And if you want to chat amongst yourselves, of course, use the chat pod to do that. And with that, I will introduce our final 2 speakers of the day to talk about everything that's going on with the FASB and the GASB. So we have with us Roselle Benoit. Roselle is a director with our not-for-profit industry group. And then Bonnie Cox, who's also a not-for-profit industry group member and partner with the firm. So Roselle and Bonnie, thank you so much for taking the time, and I will hand it to you to take us through things.
All right, thanks, Matthew. Hi, everybody. We're excited to be here with you today. We're going to be talking about FASB and GASB and what are they up to. So here's some nice pictures of Bonnie and I. I was glad to see when I got dressed this morning that I did not wear that top so that I wasn't looking exactly like my picture today. But anyway, I'll have to keep that in mind for future webinars. So first off, we've got a polling question. So we thought it'd be nice to get a sense of, what type of organization we have. So, if you're health and welfare, professional and trade, education or related, and then other. We're up to 91%. So I think we leave it open for 60 seconds. So we've got a little more time. If you haven't gotten your vote in, go ahead.
All right. Are we ready to share the results?
Here we go. So it looks like we're pretty evenly split. We've got a good bit of other, some education, institutional related orgs, and then health and welfare. All right, so we'll stop sharing those. All right. As far as learning objectives, always got to have the learning objectives up here. In summary, we're hoping that we're going to give you a quick update on, what GASBs and FASBs you should be really thinking about for this next coming up year. And then we've also got some changes that are affecting us, which will tangentially affect you, that we're going to talk about as well. So the next poll, we just wanted to see how many FASB and how many kind of GASB organizations we have today.
And Roselle, when you were talking about things that are affecting us, we were talking about kind of affecting things from the audit standards perspective and from the auditor perspective. Roselle and I both are auditors by day. But we recognize it's not always an us and them situation that we might, it's just a different hat that you may be choosing to wear, whether or not you're thinking about it from an organization's perspective or from the auditor's perspective. And so we'll touch on a few of those things today.
So we've got about 96% All right. So everyone can see the results. We're about 85% FASB and 15% GASB. So that's great. Got some people that will be interested in both. Good.
Yeah, and not really a surprising split there, I guess. I mean, not-for-profits primarily in general are following FASB standards, but we do have a good chunk of not-for-profits that also follow GASB. So that split, I guess, is not very surprising.
Well, so first we're going to talk about leases. I'm going to talk about leases from a FASB perspective, and Bonnie will be talking about leases from a GASB perspective. You know, I don't know about you, Bonnie, but I feel like we've been talking about leases forever. And, you know, we've gotten to the point where we're kind of finally here. So I don't know if you remember, but due to COVID, they delayed the adoption of this. So if you are a 12/31 year end, you'll be adopting this lease standard effective for your 12/31/2022 year. And if you're an off year end, you'll be adopting it for your 6/30/2023 year. So it's really kind of finally here to be adopting the lease standard.
Yeah, and I thought it interesting with the different tiered on the FASB side with not-for-profits, the ones that kind of affected that what were considered the public not-for-profits, which really kind of just spoke to the conduit debt holders. And so I guess, can we just have a raise of hands? Can you just use the raise hands if you have already implemented, either by early implementing or by, you know, being required to by falling underneath that conduit bond obligors, having a December year? Can we just see a raise of hands from the participant using the raise hand function in Zoom? I believe it will be at the bottom of your screen. Can we just see, get a gauge for how many of you have already implemented, either required to be or not?
Looks like we've got maybe about 30 people who've already adopted.
Okay.
Luckily for y'all, we can't call on you and get you to help us lead this session. Anyway, we just wanted to point out as a reminder, so when you adopt this new lease standard, you'll have both your financing leases which are on your balance sheet now, will stay on your balance sheet. And then the operating leases will also end up on your balance sheet. We've got a quick little summary here about how that will appear. So most entities that have already adopted, you can see that for both the finance and the operating leases on the statement of financial position, you're going to have a right of use asset. Most of them have said, you know, financing lease, right of use asset, operating lease, right of use asset, to kind of call out the difference between the two. And then the same with the lease liability, just making some designations between which is related to your finance and which is related to your operating. As far as your statement of activities, if it's a finance lease, you're going to have some amortization expense for that right of use asset, and then some interest expense associated with it. And then for the operating leases, you're just going to have one single expense. And then also for your cash flow, just slightly difference between the two. For financing leases, you'll have your interest expense, of course, in your operating activities, and then the principal payments on those down in your financing like you currently do. And then for the operating leases, it's all just going to be up in your operating activities.
And Roselle, one point I was just going to make of what I'm seeing as I'm seeing clients implement this standard is on the operating leases. You know, the asset and the liability do not always equal themselves. Like when you actually run through the calculations, those two amounts do not equal themselves. So even though it's running through rent expense, you still are almost seeing the offset of that interest portion, if you will, of kind of that liability amortization that is just flowing through essentially that same account. So it's kind of adjusting that rent expense on the statement of activities there, which that's something that I don't think I really realized until I actually started seeing the numbers and seeing the journal entries kind of flowing through there. So again, the finance lease kind of having the depreciation and interest component, which are pretty clear. We're used to that because we understand what financing agreements look like. But the operating side, once you put that right of use asset on there, along with the liability, but those numbers don't always equal, it's all kind of running through that same rent expense account there. It's just an observation that I've seen as people have been, that helped me to kind of realize that.
Yeah, no, good point. Thank you. The other thing that I know people are always wondering about is, how am I going to adopt this? Does Cherry Bekaert have a tool out there to help you with it? And the answer is yes, we do. So we have this great software solution called Lease Crunch, which can really help you walk through kind of that adoption process. And we've even got on the next couple of slides some snapshots of that. So this is just a brief little snippet of what the tool looks like. It goes through and asks you each of the questions that you kind of need to be able to differentiate. Are you looking at an operating lease or a financing lease, and so that you can properly categorize it? It'll help you as you're going through and trying to break out some of the differentiations as far as, how do I account for, extension terms? How do I account for economic life? What kind of discount rate should I be applying to this? It's a really handy tool. And then at the end, it'll, give you a little, here's the classification for your lease. The other thing that's super handy about it is it'll give you the journal entries as well. So the journal entries for the adoption, as well as the journal entries for when you're going forward. And it'll even give you all the information you need for the footnote. So we always like to point this out because, if you do have multiple leases and you're just trying to figure out, how do I get my arms around this? This is a great tool to use to help you with it. It feels a lot like kind of your fixed asset system software. So it's really easy to use.
And it certainly is not the only one out there. There are multiple lease softwares. I'm sure you guys have had your phone ring. My phone rang just this morning with someone trying to offer me another software to implement 842. I'm sure you guys are doing the same thing, but let's just do another hand raise. So like, how many of you either already have or intend to purchase some type of software to help you with your 842 implementation? I just kind of want to get the gauge on what you guys are thinking there. I've got a client with as few as 3 leases, and they just bought the software just because it's going to make their lives easier. It's the other thing that it's like, if you have a lease modification, it's so much easier just to go in and adjust it in the software, and it kicks out the new journal entries. But looks like a handful of people kind of either already intend to or have. But again, just a tool, just a tip that you don't do the math there.
Well, and to Bonnie's point about there being lots of software out there, I know when the lease standard first came out, Cherry Bekaert spent a lot of time looking at a bunch of different software to see what's out there. And this is one of the ones that we came up with and really felt like this was helpful and user-friendly. And so decided this is one of the ones that we really want to make sure that we're talking to our clients about as a great option. So next we'll talk a little bit about GASB leases.
Sure. So GASB 87, and I know a handful of you are in the GASB world. And I think I saw somewhere in the chat that some people are saying that they're subject to both. And so I know many organizations, especially if you're affiliated with a larger organization, there might be a need to do a FASB to GASB conversion type at the end of the year, even if your audit, standalone audit might be on FASB. So while the standards are very similar, they're not exactly the same. One thing that GASB 87 does have, it does not have the dual implementation dates. So it's kind of basically going to start being implemented in fiscal 22 for most people. If you want to go ahead and flip to that next slide for me, Rosa.
Yes. There we go. Sorry.
Yeah, that's okay. You're trying to everything on this slide. No, but again, it's been out there forever. It did get delayed, but anyway, so beginning after June 15th, 2021. So that means kind of if you're on a June 30 fiscal year end, basically your July 1, 21 is really where you need to make sure you've got those beginning balances. So that we can kind of do that. Didn't have that conduit debt difference, like I mentioned before. It's just kind of one effective date out there. So let's talk about what that means. So again, very similar to the FASB, they're used to have capital leases and operating leases, and now substantially all of them kind of treated as these financing leases. And so let's see what that really means. one of the things that I have found in helping clients either implement the FASB 842 or GASB 87 is almost the definition of that lease. And so under GASB, it's important that you're looking at all kinds of contracts that just have greater than that 12-month period. It's more specific about this control in the definition of what counts as a lease. And so we'll kind of look at those two different prongs to meeting that definition there. What I've not yet seen, and I'll be curious, and if anybody has been through this situation already, I would love to see you raise your hand. But in someone having implemented GASB 87 and then having to go through that conversion, have you found a difference in the implementation of if you're having to present the same agreement, the same contract under GASB versus FASB, if you're seeing that becoming a FASB to GASB adjustment or not? I'd be curious if anyone has seen that. But anyway, it's kind of the way GASB lays it out. There's a two-pronged definition of the controls where you can have the service capacity, you have that right to use that service capacity of the underlying asset, and the right to determine how that asset is used. And so those are kind of the two ways that you define. I will tell you, there are really good decision trees out there and models that you can take an agreement and kind of walk through that decision tree to determine, number one, does GASB 87 apply to this respective contract there? So make it easy on yourself, use those decision tree tools and document that. And we'll walk through a couple examples here in just a second, but I will tell you if I put on my auditor hat and knowing that kind of one of the risks is that did the particular organization under GASB 87 determine that, basically consider all the appropriate contracts to see which ones are applicable. And the way I've seen clients be able to document that is literally just an Excel listing out, these are all the contracts. And then here's how we determined whether or not GASB 87 applied or not, and kind of having those decision tree tools to document that consideration. That's really what I would recommend best practice, to kind of be able to just hand over to your auditor to be able to say, yep, we considered all these. And even though there might be 50 of them here on my list for consideration, only 2 of them really apply. We only calculated and implemented with journal entries those. But anyway, just one thing. So let's just talk through a couple of examples. And I don't know that these are, okay, yeah, I didn't know if we were going to have the answer on the same question here. So let's talk about this. If a government or a not-for-profit following GASB is leasing land, which has marketability, market rent of $100,000 a year, but they're only charging $1 a year. So it might even have the word lease in the agreement. So does GASB 87 apply to this transaction? Market rent would be $100,000. But the organization only pays $1 a year. Roselle, what do you think about that one?
I thought this one was kind of interesting. I will say that when I first read it, my inclination was the wrong answer. I'm not going to tell you what my inclination was. But so that's why we thought this one would be a good one to include, because it's interesting.
Does anybody want to sign up in the chat or
well, let's do a hand raise.
Okay. How many think yes, GASB 87 applies? Yes, GASB 87 applies. Let's see if we're raising our hands. Lots of people voting yes there. All right, kind of evened out a little bit there. So not to start it off with a trick question. This answer, in this case, 87 would not apply. And it's primarily because we need to only consider 87 for either an exchange or exchange-like transactions. So in this particular example, you've got market rent of $100,000, but you're only paying $1. That by definition does not qualify as an exchange or exchange-like transaction. So this would be one you can have it on. It might be a 30-year lease. It might be a land lease. It might be something like that. Have it on your list of things to be considered, but then you'll be able to easily say, no, it's not applicable because it's not considered an exchange-like transaction. So, all right, let's try another example here. All right, so this is a contract where the lessor can replace the underlying asset with an identical asset. Okay, so is that right to use? Is that substantive right of substitution affect whether or not GASB 87 would apply. Let's say GASB 87 applies for all the other reasons. The only additional component to this is the lessor has the ability to replace that underlying asset with an identical asset. How many people would say, yes, it applies, it still applies, no, it does not? Raise your hands if you say, yes, GASB 87 still applies. Got people raising their hands? Got some people in the chat here saying no. All right, so this one, I will say the slide was a little confusing for me, but anyway, so the answer is no, it doesn't affect the application. So the answer would be yes, it would still apply because essentially it's the right to use that asset being distinct from that underlying asset itself. So again, right to use, not title to that asset is kind of where we are kind of drawing a distinction there. Leave it to GASB to throw in all these little.
That's right.
Components there.
They wanted to make sure they were a little different from FASB.
Yeah. Yes, exactly. All right, last question here we're going to talk about, and this one I would say I've been down the road exploring this one. Cell phone towers or antennas. Are these agreements where you have cell phone towers or antenna placements? So those agreements, leases. A lot of governments have these, a lot of local governments, but I've also seen applicable where not-for-profit organizations are also subject to this business too, where you've got a cell phone tower or antenna placement agreement lease in place. How do you guys feel about that one? Is that going to be applicable to GASB 87, or what have you seen? Have you seen? Yes, got a few people raising their hands. Yes. So this one, of course, is the typical answer. It depends. This is the one where I have seen the most kind of, you really just document your consideration of control criteria to figure out whether or not it does. I'll tell you, it's not just cell phones, it's all types of like broadband, like all types of utilities that can possibly, that do have agreements that are greater than 12 months between parties. And so this is the main area where I've seen it really is beneficial to kind of take the time to kind of document and walk yourself down that decision tree. And at the end of the day, it's judgment, just like many things in accounting implementation. And so again, putting that thoughts on paper and that judgment on paper to kind of provide to your auditors will really help you be able to not have any surprises come audit time. So now let's just kind of look at the basic recognition. As you would expect when it comes to GASB, you for both on the lessee side, you'll have that intangible asset that'll kind of be that present value, and then have the liability for those payments. But on the lessor side is where you have that lease receivable and then the deferred inflow for those upfront payments kind of thing. So a little bit different depending on whether you're talking about the lessee or the lessor, just because we have to use that. We don't have to. GASB likes that other credit line item called deferred inflows that we have fun with there. But anyway, just kind of summary there. And then on the activities statement.
Sorry.
That's okay. No, you're good. Go ahead.
Oh, you have the next one? Okay, sorry. Vanna issues here, y'all.
Then just amortizing that life of the asset like you would expect, and then reducing the payments like you would a note payable for the payments there, considering the interest. And then same thing on the lessor. You've got a receivable, so you'll just reduce that for the payments being coming in, and then straight line through revenue on the deferred inflow there. So just kind of as you might expect there. And then of course the disclosures are going to be similar to what you would expect to see on commitments and contingencies, combined with asset financing purchases there. So no real rocket science there when it comes to it. So I think that Roselle, that brings us to our next polling question. So whether or not you are in GASB world or FASB world, tell us how you feel about this. You're feeling great. We've already implemented. We've started trying to assess that impact. We don't really have very many leases, so we're not worried about it. And then I would say when we did this poll a year ago, there were a lot more people that were worried than not. So anyway, just kind of seeing, I don't know, Roselle, what have you been experiencing with your clients as they've been implementing the lease standard?
I think, the ones that have started thinking about it early, and as you mentioned, getting that lease list together for the leases, have really, been able to feel a little more comfortable with adopting this standard. I do think that it looks like right now we have more that aren't particularly concerned, and I think that that's kind of where at this point it's kind of a good place to be. It means that you've thought about it and are starting to do some assessments and stuff.
I would encourage you, especially in 842, if you're on the lessor side, there are several practical expedients that are included in the standard that kind of give you a way out for kind of existing leases. So I just would encourage you to take advantage of the practical expedients to get there. So, all right, good deal.
All right.
Very concerned. Oh, yeah. That's good. That's good. I still would encourage to put that list together of all those contracts that it'll help your auditor out to be able to get and assess that completeness there.
All right. So next we're going to talk about ASU 2020-07, which has to do with contributed non-financial assets. So this would be any sort of gift that you get that's not cash, pledges, investments, that type of thing. So non-financial assets. And really the FASB issued this to try and get everybody on the same page as far as how they were presenting and what they were disclosing.
Roselle, let's see. Why don't we use the chat for just a second and say, what examples do you guys expect to see? Where have you already thought about what this might, or maybe we'll just raise hands.
Let's do it in the chat.
You want to do the chat? All right.
Yeah, let's do the chat.
Yeah, let's see here. What types of non-financial asset contributions are you guys dealing with now for which might be applicable to this? In-kind donations, land. Yeah, I agree. Non-financial assets, artwork, none, rent coming in.
Yeah.
Books. Oh, I wonder if that's a library or a school. Yes. HVAC equipment. Wow, that would be great. I wonder who's getting some HVAC equipment. Professional fees, equipment. Yeah.
Pharmaceuticals. Yeah, I keep waiting to see, food and Goodwill. That's definitely one that would apply to Goodwill, that kind of thing.
If we were asking this question last year, it probably would have been all PPE.
Yeah.
So, okay.
All right.
Good deal. Let's see what we got.
All right. So the main provisions are that FASB now wants you to present a separate line item for those contributed non-financial assets. And then you'll also have an expense just so that those items pop out a little bit more. And then in addition, they've added some enhanced disclosures. So we'll go through those next, just so that you can see what those are. So one of the items that they want is for you to add some qualitative information about whether or not those assets had been monetized or utilized. So did you decide, okay, we're going to sell it and convert it to cash, or did you decide that you're going to use it and put it into service? And then, any sort of policy that you may have, if you don't have one, anytime, they say NFP policy, if any, it's always best to think, maybe I should put a policy in there, kind of like the Form 990 when they've got the little, do you have a policy for X, Y, and Z? And if you say no, it's always kind of an interesting place to put you. And then as far as whether or not there's any donor just imposed restrictions, and then, the valuation techniques that you use to determine the fair value of those. And then, depending on what the asset is, the principal market used for that. One person asked about cryptocurrency. And it's interesting because I don't know about you, Bonnie, but I've started getting a lot more questions about cryptocurrency. And I think that cryptocurrency falls into more of kind of an intangible type asset. The FASB has started putting out some guidance about, how to record cryptocurrency. But anyway, that is definitely one of those areas that we've started to get a lot more questions about recently. And I think that there's going to continue to be a lot more guidance on that.
I would love to hear the debate of people who believe cryptocurrencies are a financial asset, not a non-financial asset there, but I'm sure we could get about as many opinions as we wanted to.
Yeah.
And one of the things that I think is important based on the examples that kind of the group kind of shared with us of what they are receiving, I'm sure most 90% of them, they're probably already recording these through revenue and expense because, most of what they shared with us are examples. And so I think aside from the disclosures, which we'll go through that in detail, one of the biggest impacts that I'm seeing in my clients are the requirement to pull that out on its own separate line item for revenues there, because I've got some, and for some clients, it's gonna have a big impact to kind of really pull out those non-financial contributions on their own line rather than be included. But at the same time, I can see why it might be meaningful to the users to kind of show that separately.
Yeah. So this next slide has an example disclosure. Again, you can see, it's showing the amount that you recognize. It's got the utilization. So, where, and in this example, all of them were utilized for program. They decided not to liquidate and monetize any of them, whether or not there are any donor restrictions, and then all of the various valuation techniques that were used. So I think this is a nice, calm way of showing this presentation. Time you can get something in a nice table, it just makes it easy to use and review that information for the disclose or the user.
I know I have some of my foundations that their gift acceptance policies are pretty strict as far as what they can accept. And so I've just been encouraging organizations to use this standard in a way that it helps your organization too. I mean, it's a big burden on you guys in the financial reporting roles to have to gather all this information to figure out what valuation techniques were used. I mean, it's no longer just, somebody wants a tax deduction. So here, take this or take that and get it off out of my portfolio. Give me a deduction for it. And here, I'll give it to you, my favorite organization. But sometimes, maybe this is not the case for you guys, but sometimes I've seen clients have to deal with a lot of time and energy and pain just to be able to not only accept those gifts, but then figure out what to do with them. And now there are all these expanded disclosures that are also going to accompany that. So one thing, accounting standards are what they are. And those of us who are in financial reporting and audit roles, we know how much fun and useful these things are. But, for your board members and for your directors and people more in that role, and in the advancement roles too, I just would encourage you to use this standard to help the organization, maybe refine that acceptance policy so that we're not set up with a headache down the road because you're not able to gather the information that's required to be disclosed now for that. But that's a point from taking accounting standards into real life.
Yeah, no, good point, Bonnie, good point. And I think that's the other thing I hear, that it's expensive to get all this stuff valued. So the big question, when does this apply to me? So this is going to be effective for if you're a fiscal year end June 30th, 2023. 2022. And then if you're a calendar year end, it would be for your December 31st, 2023 year. So, something to be thinking about now. And as Bonnie pointed out, this would be a good stick, if you want to try and do some refining to your gift policy, you can use this as a reason for that.
And just the point, because it is applied retrospectively, even if you choose not to implement until the end, if you present comparative statements and you have those non-financial assets contributed, then you might be in a position where you're having to go back in time and get those valuations. And that is what's really can be considered. Roselle, a question kind of came in that I think might be helpful. So one question came in that said, should stock donations that are immediately liquidated be included on the contributed non-financial assets disclosure? So what's your opinion on that?
No, the stock gifts are not subject to this because they are financial assets. So they would not be included in this.
That's what I was thinking. And that's why I think it's interesting, because some people, like the cryptos of the world, really still believe that is a financial asset. And I don't know, that's an excellent question. I can't wait to dive a little bit deeper on that to figure out what we can get. I'll have to get somebody with a smarter financial asset brain than mine to try to come to that conclusion. That's a great question to get there.
All right.
All right. So GASB 96, there are several slides that are included here. And I guess I was under the understanding that we were going to be sending the slide decks out. I'll just say, and we only have a handful of people on the program today that are GASB, but we're not going to go in deep dive with this, but we'll talk about it because it is coming up primarily in 23. So let's just talk about GASB 96. And this is one where I feel like the GASB standards, it's like, could we make the title of the standard any more confusing?
Convoluted, yeah.
Yeah. So subscription-based information technology arrangements. So it's like, what are we really talking about? And when it comes to practical, these are really software arrangements that you have with third parties. That's really kind of, software as a service and that sort of thing. And GASB just kind of speaking to it specifically. It is going to start being effective in the 23 fiscal year ends. And so if you kind of look at the way that effective date is written, beginning after June 15th, 2022. So that'll be your June 23 fiscal year ends and your December 23 calendar year ends are kind of when this is going into effect.
I think this is another one of those where it's like GASB trying to get on the same page as FASB.
I agree. And again, I've not personally implemented this standard anywhere, so I really haven't seen how it lines up to how closely it aligns with the FASB. So it'll come back to like, is it defined exactly like FASB is, or is it going to be one of these conversion adjustments again? That would kind of like, I don't know. It'll be interesting to see how that shakes out. But similarly to the lease standard, it does kind of go through the control definition of what really, question number one, does it apply? Does 96 apply? And you kind of have to go through these here. But I will tell you, and then it kind of goes into how you calculate that. If you want to kind of go ahead and flip to the next here, goes through all this criteria for doesn't meet the subscription terms, kind of like if you can imagine, it's very similar to 87, very, very similar to how it kind of lines up of how does it apply and then what policies do you need to set? Does it really qualify? And to be quite honest, what I am seeing and hearing is that there are software companies that are already figuring out how to calculate this for you. So I really think it's going to be one of those things that we could spend a lot of time figuring out how to calculate these assets and liabilities and amortization schedules and that sort of thing. I don't think 96 is going to be as widely applicable as leases are, just because of I don't know how many either governmental organizations or not-for-profits that are following GASB really have a tremendous amount of these types of agreements. But it's very similar. And like I said, I'm already seeing software vendors out there trying to sell how to implement it there. So I think we can kind of go ahead and it's like,
oh yeah, tell me when to stop.
Think 87, but applying to software arrangements. That's all I can. The rules are different. Implementation pain is going to feel the same. And I'm sure someone will be trying to sell you software to be able to help implement that for where it's necessary. So I think we can spend more time talking about other things.
All right. You want to go to the poll question?
Sure. So the poll question. Because I suspect there's more people that might have goodwill in the organizations, but that may not be the case. So, this is something where even under FASB, not a lot of not-for-profits have goodwill because not-for-profit organizations generally are not doing a lot of business acquisitions. Obviously there are intangibles, but probably more, maybe even on the intellectual property side. I don't know.
Yeah.
So the main place I've seen goodwill in not-for-profits is when they have done acquisitions for whatever reason, either acquired another not-for-profit organization where it's been more of a business combination, like a combined effort, or they've taken an existing, like a member organization, and they've kind of got some kind of not storefront, but more like a retail type business here. That's where I've seen a lot of goodwill and intangibles, but let's see what the audience says.
Well, and I think the other reason we wanted to talk about this a little bit is because the news keeps talking about how, more and more not-for-profits are going to be doing mergers and acquisitions. And so that's why we thought we'd go over this just a little bit. So it's on your brain as if you do end up going through some of that stuff. But, it looks like 21%, maybe that's not too bad. All right, y'all. So just one slide, y'all, on Goodwill and Intangibles. We just wanted to go over kind of a trio of goodwill changes that apply to not-for-profits. The first one, ASU 2019-6. This is the ASU that extends to not-for-profits the ability to amortize your goodwill over 10 years, which is a great way to handle that. When you amortize it, it means that you're only looking for impairment if there's a triggering event. You don't have to necessarily go through and do that impairment analysis every year, really only if you feel like there's a triggering event. The second one, ASU 2017-4, simplifies the test for goodwill. So it gets rid of step 2 of the goodwill impairment test, which makes it a little less burdensome to be doing it. And then the other one, ASU 2020-03, this one goes through and allows you to perform that impairment analysis at the end of your reporting period. So you only have to look at it at the end of the reporting period. It's more of a point in time assessment so that, as you're going through the year, you don't need to be thinking about, do I have any triggering events? You're only looking at it at the end of the year. So I think that those should be some helpful to make, accounting for goodwill and intangibles less burdensome.
Yeah, like you said, Roselle, just know that if you do happen to have it or get, go through something that there's guidance out there that is kind of specific out there to be followed by not-for-profits. So,
yep. Next one, we're going to talk about some auditing standards. And I will say, Bonnie, I thought I had a polling question for this, but I guess we didn't.
You do, but I think it's
afterwards.
At the end.
Okay.
I think it's at the end. Yeah.
All right.
Skip to the polling question if you want to.
No, it's okay. We'll wait. I was just thinking, y'all are probably wondering why in the world are we including auditing standard updates in our FASB GASB implementation? And so we have included it because one of them specifically, SAS 134, will have a bit of an impact on the organizations. So on the next slide, I'm going to blank this out so that you don't feel like we're going to talk about all these other ones. We're just looking at SAS 134. And the main changes there is that there's going to be a change to the auditor's report. There's a new term called key auditing matters that I'll talk about a little bit. And then there's a specific focus that they put on auditing disclosures. So the first one changes to the auditor's report. So, the AICPA, I guess they felt like the auditing report was getting a little stale. They wanted to jazz it up a bit. Bonnie made a face when I said jazz it up a little bit.
Because audit reports can be so engaging, so fun to read.
It is. We like to think that it's very important,
yes,
and that the users are automatically flipping to it to read it.
Yes.
So they've changed it up a little bit. So the big difference is just some reordering of items. So the audit opinion is going to be the first paragraph at the top. Then we'll talk about the basis of our opinion, go over management's responsibility, and then the auditor's responsibility. And then they've changed up a little bit of the verbiage just to highlight items. They define what reasonable assurance is. It's always been in there, but maybe not a specific definition. And then a little bit of changes to management's responsibility and our responsibility in order to just make that clarified and, add a little more information to it.
The thing about it is though, Roselle, at the end of the day, it's not really changing what it means.
Right.
It's changing the look of it. It's changing the order to it. It is making it longer. Yay for all of us. But at the end of the day, it's not really changing what that audit opinion means or what the responsibilities are there. So lots of work on the auditor's part.
Yep. And then the next one, the key audit matters. So those of you that have ever worked for or are familiar with the PCAOB, the public registrant standards, they've already had some key audit matters that they have been disclosing. And I think that the ASCPA wanted to give private entities an opportunity to also report that. And so the thing that I think is important to make sure everyone remembers here is that the key audit matters are not required to be reported. So this is something that, the client and each entity can determine whether or not they want to report these.
Roselle, have you had one of your clients choose to include this yet?
I have not. I will say though, that we have not. I kind of feel like this is one of those things where people are going to be like, well, let's see what everyone else does, because I really don't think that any of the public registrants were like, yeah, I want to disclose this. It's like, okay, we have to disclose this. We're putting it in there. So I think it's great that they made this optional. And I think it'll be interesting to see where it goes with it being optional. So anyway,
Yes.
One of the things we wanted to point out, key audit matters would primarily be some of those items that would involve judgment, could be considered, more of a high risk audit area. So that's really what you would see disclosed here. And again, it's not a required disclosure.
The last impact to me that is just important to bring to the attention of this group is that on the next slide where it's talking about like auditing the disclosures. So you may feel like, or you may see that your auditors are asking more questions about the amounts of the disclosures. They might be tying more things out and do more testing to the amounts that are actually in those disclosures. And that is because of the underlying changes with 134. So just kind of, especially as you're going and implementing these new standards for whether it's the 842 or the non-financial assets, where there are expanded disclosures, just know that the audit standards are asking us and requiring us to do more in the testing of those. Not that they always weren't covered by the opinion, but we have more specific guidance in the audit standards for what that needs to be.
Yeah, and one of the things I thought was interesting about this is that, in our audit report, we say footnotes, but we don't necessarily specifically say the word disclosures in that. And so I think that the ASCPA really felt like they wanted to make sure that, people were aware that the footnotes meant disclosures. So they put this guidance in there to really make sure that the auditors are making that connection as far as, here's what the footnotes mean. They mean disclosures. And they go through and specifically highlight some of those items that they really think that auditors need to make sure that we're buttoning down as far as sensitive, audit areas, related party transaction. That's always one of the areas, that the ASCPA really wants to make sure that we've got nailed down. So these are kind of the big items that they're thinking about and want us to be spending some time looking at. So to Bonnie's point, if you get some additional questions, it's really to make sure that we're complying and meeting the spirit of the standard.
All right, so now let's go to that last polling question.
Okay, I know. I'm like, Bonnie, how are we doing on time?
No, we're good. We're good.
Okay.
We're done. Robin?
Well, this has been fun because I never thought I could sit through an accounting standards updates where two practitioners cracked each other up so much as the two of you did. So that was really fun to watch. And this wraps up and concludes, the last session of our seminar for today. So we thank everybody for joining us. Of course, there's 4 more sessions to take place on Thursday. So we really hope that you can join us again. Some of those sessions will be really good. We're going to talk about best practices around endowment accounting. And I know a lot of people struggle with that. So we'll talk a deep dive into that. We'll talk about when is the right opportunity to do outsourced accounting. We're going to be talking about digital transformation and then some legislative updates and impacts for employers. So lots of good topics on Thursday, and we will see you again starting 9:30 a.m. Eastern Time on Thursday to pick up with best practices in endowment accounting. So thank you very much, Roselle and Bonnie, and thank you for everyone for wrapping us up through the first day. Appreciate it.